The Dow is down right now. And there's your picture by 300 points. We know the market doesn't like uncertainty, Mel. That's a given. But this may be a whole new realm of chaotic uncertainty by virtue of what the president just said. And I know you've been watching yields as well. Bond yields are dropping like a stone. We were, what, 94 basis points earlier in the evening?
We're at
and now we're at 77. So that just gives you an idea of what the feeling inside the market among investors is as it tries to process what could be in store over the next several days at a minimum.
And you look at the move in the Treasury market in the context of the move in the futures market, and you wonder if this is not just a reversal of the anticipation of a blue wave, which would mean more spending, more debt issuance, higher yields, but maybe this is actually a bid for safety. At the same time, Scott, when we take a look at the futures board, you see the Nasdaq up by 1%. So you're kind of thinking, what is going on here in terms of how the markets are digesting this all?
Yeah, no doubt. Let's bring in a couple more voices familiar to our viewers, Mel. Joe Terranova, Degas Wright, they're both, of course, members of the Investment Committee on the Halftime Report. It's good to see you both.
Thank you.
Good morning, Scott.
Joe, I appreciate you staying up. Degas, you as well. As I said with Mel a few minutes ago, markets hate uncertainty. Better get used to it.
Yes. Well, best case scenario, you have a delayed election result. Worst case scenario, you have a contested election result. And that's clearly represented in what you and Mel were talking about with the 10-year Treasury pricing from 94 basis points down to 77 basis points. I think we go back to the prior script where you look at mega cap technology and it acts as a bond proxy. I think that's one of the reasons why you see the Nasdaq higher. But let's kind of look past all of this and realize that something happened this evening that is very good for risk assets. And that's the formation of government that suggests gridlock moving forward. I think there's a surprise in the Senate. We could wave goodbye to any potential wave, and longer term, markets like that outcome.
Yeah, unless, Degas, the best play for people, because things could change so dramatically by the minute, the hour, the day, and who knows, the week, maybe the best advice is to sit on your hands. I don't know. What would you tell people to do tonight?
Well, obviously, we'll tell them to just stay where they are with their portfolio. You know, one of the things that I noticed that once the president got up to the podium, I watched the futures go from green to red. And as we were talking about earlier, this is exactly what we wanted to avoid. We also look at risk management within our firm. And one of the things that we looked at was the futures and also the implied volatility going out to January 21. And what we notice is that the SPY, the U.S. market, actually has a higher volatility, implied vol, than China, emerging markets. And so that tells us right now that the market is really putting in a future volatility. One of the things that we noticed, too, in that the volatility out in January is a little bit lower than it is today. Right now, we're at about a 35 of VIX. The implied vol for January is down to about 28, but it's still higher than China emerging markets. So we're really in this for a lot of volatility, and the market's seeing that.
I think you're going to be right. Degas, thanks. Joe, thanks to you as well.